We have two short comments that we're going to enjoy during lunch today. These are both people that have been working with us on some of our climate initiatives and really have a fresh perspective that I think is helpful. First, Diego Herrera is going to join us, who is from the Inter-American Development Bank. He's been a lead specialist in the Connectivity Markets and Finance Division for the last 8 years, and is involved in the stress testing work that we've been doing. Before that, he was Superintendent of Market Risk and Integrity at the Financial Superintendents of Colombia. And after he has spoken for a little while, we'll be fortunate to be joined by Richmond Mayo-Smith, who is a private investor who focuses on sustainable investments in emerging markets. He's founded Climate Finance, and for the past 2 years has been working with Crane Shares to create the first ETF that creates a global price for carbon allowances. I mentioned it this morning, and it's actually doing extraordinarily well over the short period it's been trading in our portfolio comparison. And he is a member of the NYU Stern Board of Trustees. So let's start with Diego, and why don't you share your screen?
Thank you very much, Rob and Dick, for inviting me over. This is a pleasure being here back in my alma mater. And I just want to show something from the perspective of what happens in reality in our region. I would like just to start off by sharing my screen really fast. And essentially, I'm just going to go very fast through some of the things we're doing and we are watching. We are currently working on a global regulation study. But I would like just to mention that for us, all the discussion on data has been very rich. I have listened Commissioner Alison Lee and many other people from the former panels that have spoken about that. I think that the approach on, I'm sorry, something happened here, that the approach on data has to be divided into two main sources of data. One is climate change, precisely the climate risks, physical and transition risks. That's one set of data that we have to look at, but the other one is the ESG risks, and that's another set of data. Those are interrelated but separate. And from the discussions this morning, and especially from the latest panel, after listening to Mr. Styron, Natalucci, and Bracer, all of them mentioned the importance of data. And I think that it is one of the main things that we have to go through in our region. I think that the supranational organizations are doing very well to that respect from the last couple of years. I think that things are moving fast. They already mentioned in the last panel how things are evolving. I would like to highlight especially the work that IOSCO is doing and the work that they've been doing with the IFRS Foundation and SASB. And I do think that for 2021, what they have been doing is focusing on asset managers and greenwashing and the ESG ratings and data providers. I think that we will be slowly moving towards some kind of a standardization of which are the minimum contents of these ESG ratings and what should be the standard for a good ESG rating. I feel, I know that many of us remember like the late 90s and the early 2000s when we were looking for standards for market risk. And in the end, the model of risk metrics was, and all the adaptations of risk metrics were the standard. We are in a similar type of vibe right now with all these standards, especially this one I'm highlighting here for ESG disclosure. And in the end, I think that we are all moving through the same path, and also something that is important, and they already mentioned it, but I think that there is a lot to learn from the insurance industry, because it's their pain, is what they are specialized into, and the premiums and everything that they have done to calculate these types of risk are sources of knowledge and information that the rest of the subsectors of the financial sector should take advantage of. Um, just to go through Latin America really fast, this is Guns N' Roses, my favorite band, and they had this song where they say, "Where do we go now?" But well, the answer is that we are going well, but we are still missing a lot of action and a lot of things that we have to do across the region. Mainly what we have across the region in terms of regulations is ESG regulations, and in some cases, frameworks for sustainable bonds, very few things on climate risk, very few things on stress testing. We're still waiting, but some of the countries are already taking action to that extent, such as Brazil or Colombia, which are already acting on doing climate risk related specific actions. So to that extent also, I would like to mention Chile, because they are working not only in revelation, but also in some exercises related to climate risks. So I'm going to the practical thing about supervision, and it is the blending of the climate risks and the ESG risks. And going through that is a complicated matter for supervisors. It needs a specialized let's say, personnel who are in capability of understanding that thing. And this is a huge challenge for all emerging economies. Further, more if we have the FSAP examinations going through. And I know for sure, because I've seen it already, that especially for emerging countries, the requirements on the side of ESG risks and climate risks are hard to comply as of now, and we are working as an institution to that extent. As Professor Engel mentioned, we are working in a C-risk exercise. We have a lot of challenges to go through. This exercise will comprise the results for Brazil, Chile, Colombia, and Mexico. We've been working with the financial authorities of these countries in trying to do this systemic risk with climate risks measurement. We have, as has been already mentioned, a huge challenge with data collection. We have seen also a lot of challenges in terms of the coordination between agencies, because, for instance, climate risk, especially the physical risk data, belongs to environmental agencies or climate change agencies and so forth. So it's been a challenge to gather that data, that type of data, into what we need for the set of models that Hayun showed previously. And also we have to do some coordination with the private sector, and it's been challenging but interesting. And also, as many of you know, we lack of liquid capital markets, and so we don't have as much listed financial institutions, which poses an interesting challenge also in terms of constructing the model. We have also seen other challenges, such as the role of location of assets for the sensitivity on credit risks, and it's been especially tough for large countries such as Brazil or Mexico. And that's something that they touched upon in the last panel. I think Fabio Natalucci mentioned that. And also this has been a very complicated challenge in terms for the transition risks, in terms also of the regulations and the actual data that could reveal that transitions risks are having an effect on the financial sector across the region. To that extent, we have mobilized resources. Part of those resources are part of the efforts that we are currently having with NYU and the Volatility and Risk Institute, and that's why I'm here also. And we will have a meeting for the regulators, supervisors, and the financial sectors in Latin America and the Caribbean for launching our network of regulators for sustainable finance. Obviously, when we have the results from the study with the Volatility and Risk Institute, we will have a webinar with Professor Engel and Professor Berner and Hayun, hopefully showing the results. And we will be more than happy to share the results with all of you. The QR code there will lead you to the registration for the event if you want. And if you have any questions, please feel free to send them to me. This is my email address. And thank you very much for the opportunity of talking here, Professor Engel and Professor Werner.
Thank you, Diego. Nice to have a peek at what's going on in Latin America in all this analysis. Rick, do you want to take the stage?
Sure. Can you hear me okay?
Yep.
Okay, good. Thanks for this opportunity, everyone, to share what we're doing at Climate Finance Partners. A special thanks to Robert Engel, who serves as our chairman of the advisory board, and his input on what we've been trying to do has been very helpful and exceptional. What we've tried to do is came out of a personal decision to come out of retirement to try to do something about climate using some of my skills in the financial sector. We decided to try to find a way to put a global price on carbon emissions, and working with another professor and practitioner, Aaron Bloomgarden from Columbia University, who teaches sustainable finance, climate finance. We came up with the concept of creating an index with IHS Markit that takes the weighted average of three of the most widely traded emissions trading systems. And so this is the way we came about, and the new ETF called KRBN tracks this index created by IHS Markit, which has created a global price for carbon. The current price we launched in July 30th at $20. It's now trading at $32. And it's grown from $3 to $200 million in the first 8 months. So it seems that the market has an appetite for a number of reasons. We found that people want to hedge against climate change. As climate change gets worse, they see the the price for carbons in these emission trading systems will go up. So that's one reason. Other people are looking at it as an impact investment. By participating, they're creating this global benchmark that now all the insurance companies and finance companies can use as the benchmark. We've taken the most liquid markets. I think the futures market now is about $288 billion for these three markets, which includes the European market, the California market, and the Reggie market, which is the Northeast. And I think just to give you a little bit more history on carbon emissions, Matt, you were going to put up a slide. Yeah, just a refresher here. This is the growth of carbon emissions, and to me, in my research and with Aaron, we both believe that this is the cause of climate change, and therefore putting a price on it has been free for most of the time over the last 100 years. This clearly demonstrates how much carbon emissions has grown over the last 100 years. Okay, you can do the next slide too. And right now, there's 61 carbon pricing or emissions trading systems in the world, which covers about close to 25%. The big addition, of course, is China, and that's one reason we teamed up with Crane Shares, which is focuses on China ETFs, and so they'll be joining the index probably in the next 2 or 3 years, and that will double the size of the index in terms of carbon emissions. And I think once that happens, we will be considered the benchmark price, and people will start to use what we can see as as a global price for all their various internal calculations and shadow prices. And I think, that's really the summary of what we're doing and how it's going. And I don't know if you have any particular questions that you would like to ask me, Robert, to expand on this conversation. But we hope that KRBN will become what we believe the benchmark that people can refer to. Just before you ask a question, I just wanted to mention one other thing is that I've been on a number of conversations and calls and with institutions, and I'd like to give an example of, we were on the call with one of the big tech companies, and they were trying to find an internal price to try to adjust their behavior. And they started out with $10, and we pointed out to them that already the global price, which combines Europe, California, and the Northeast, is above $25. And the next 2 weeks later, we find out that they've now adjusted their internal price of carbon much higher. So I think this is how we hope we can help companies avoid greenwashing and ramp up their actions and ambitions.
So what if if some of these commitments, like we've heard from the climate meeting this week, are actually implemented, isn't that going to drive the price up a lot more?
Yes, it will. And I forgot to show my third slide, Matt, if you could put it on, because that really demonstrates how carbon pricing, as it goes up to $100, will really affect a lot of these companies, and basically steel companies and cement companies. The cost of, it will ruin their EBITDA, and the cost at $100 a ton, you can see in steel, the cost is double their EBITDA. So they would basically be a bankrupt industry. So, and the same with cement. Utilities, it's not as bad. Chemicals is not as bad. Mining and smelters is also an issue. So already we've seen a huge run up on prices in Europe over the last, even just this year. It's doubled over the last course of the year, and I think it's gone up another 50% just this year. So it's already happening. It's not something that will happen. It's something that is happening, and we don't see it. We believe it will continue. I think the U.S. is now, with the new administration, may start to take more proactive action. And I mean, we would like to see the whole U.S. Become a trading system. So they would all conform perhaps to the California system, and everyone would link together, and we'd have one emissions trading system for the U.S., which is not so far-fetched, I think, under this scenario. I mean, I think it's a very sophisticated audience here, so they know the advantages of an emissions trading system is it lets the market determine the winners and losers rather than just taxing everybody across the board. And that's why we're in favor of emission trading systems, with China coming on board. There's Korea, there's New Zealand, there's Japan is starting to look at it as well. So we see that is probably the optimal way to do this, and gradually we see these markets evolving so that they will all be linked, and the price would go probably well over 100 if we're really going to achieve our goals of going to net zero by 2050.
Great. Well, thanks for everything, and I think we're all going to keep our eye on what the market price really looks like for this,
Thank you, everybody.
this sector, this part of the market.